Hello everyone, it is Sunday, August 1st, and this is episode 24 of Odds Are, your S&P 500 weekly market forecast. Alright, let's take a look at what happened last week. And honestly, it was a whole bunch of nothing. So if you remember from last week, I said that even though there was a high probability across the board, right, that we usually hit the breach points, and this is looking at historical data over the last 21 years, the fact that this week's breach range was amplified or really spread out because of the high volatility from that big V dip that we took about 2 weeks ago. I said that I actually believe that there was not going to be a breach of the breach points, despite the 81% chance that the statistics tell us over the long run. And that's exactly what happened. We stayed right in the middle of the range. We didn't even come close to breaching any of those breach points, which, as you all know, sets us up for something really, really cool. And that's the fact that we now have a 97% chance of a breach point in this coming week, which we'll dive into a little bit more here in just a few. But let's take a look at last week. So you can see there, it kind of went up and down, but stayed within the range. Really didn't go anywhere. In fact, we didn't even come close to the Bollinger Band, and we didn't even get down to the midline of the Bollinger range. So no activity there. Didn't come close to the parabolic SAR. Nothing happening. And of course, we closed within the expected settlement range. All right, let's take a look at the moving averages. The short-term moving average did flip back up to bullish, so we are now bullish across all three time frames. And I'm going to try something a little new here. So instead of breaking out the three different sections, so the breach points, the expected settlement range, and then the parabolic SAR, I'm just going to start off and put all of them in one screen, one picture, right? So here we go. We're just going to start off with the breach points, and there's that big 97.46%. That's the odds of a breach of one of those two levels there. The blue is where we closed at 43.90, and then the expected settlement range for this week is between 42.76 and 44.74. And it's about a 78.99, so we'll just say 79% chance that we will close within that expected range. Obviously, we still have plenty of room for it to breach one of the breach points and still stay within the expected settlement range. And then the parabolic SAR did move up to 42.13, but still outside of that expected settlement range. So not looking for a close below that number unless something major happens. But this pretty much summarizes everything that we're looking at in this week coming up. And then we'll flip the view, and there we go. So you can see now all of the different levels and the breach points and everything in relation to the price chart and what's happened recently. So if you'll notice that the lower breach point at 43.62 is right on the Bollinger midline, so that could be going down and testing that line and then kind of bouncing back up. So that would be an opportunity for a breach. Or if we get up to the top end of the Bollinger range, the top blue line, we would be breaching that 44.20 upper breach point. You see that both of the settlement limit ranges, the upper and lower settlement limits, are outside of the Bollinger range, and then the parabolic SAR hanging out down there in no man's land. All right, now, if you didn't see that one coming. All right, so last week, I told you guys that I did not think we were going to have a breach of the breach points. So I gave you the heads up on that. Hopefully you guys were able to take advantage of that. If you didn't, don't know what to tell you. More importantly, though, we have another setup, and we know what happened last time when we brought up on the show that, hey, we have a high probability of a breach point, and we actually went one step further and said that the statistics show that in a week following, right, a week where we did not have a breach of the breach points, that not only did the percentage or the odds go up to 97%, but that the breach would be with more strength, that it'd be a more significant breach. And we actually put some numbers to those, right? And so that is the situation we're faced with this week. So let's put those numbers back up on the screen. All right, we can see here that the average price action following a week with no breach, right, is 58% of the time it goes up above the upper breach point. 49.74% of the time it goes below the lower breach point. And for those math geniuses out there, yes, that does not add up to 100% because that also incorporates weeks where we have a breach of both, right? So it's very foreseeable. It's very possible for the market to breach the upper and the lower breach point, and that's why that total comes out to more than 100%. But what's interesting is that we tend to not just breach it barely, right? So on the upper breach point, we usually breach by about 0.75%. And the lower breach point, we breach by 1.75%. So the downward breach tends to be stronger than normal. And that's what we're looking for, right? We're looking to see how can we take advantage of that. So what does that mean for this week? 43.62 is the lower breach point, but given the fact that we are in a week where we had no breach last week, we're really kind of pushing that range down and saying it's very possible to go down to a 42.87. So somewhere between that 43.62 to 42.87, that's kind of like what we're looking at. And then on the top side, we have an upper breach point of 44.20, but we're saying that there's plenty of momentum, in this case, to go up to 44.54, because typically when we breach on one of these weeks, it's by about, on average, 0.75%. So take those numbers, keep those in mind. We're looking for something nearing that 42.87 or 44.54, depending on which way we break. All right, and let's wrap it up here with the quote of the week. So, Mr. Stephen Clark, he's the founder and head of risk at Omni Partners LLP, and he says, "Do more of what works and less of what doesn't." Now, that sounds really, really simple, right? It makes total sense. And yet, the question that this quote, begs is, how do you know what's really working and what's really not working? Which you would think should be a pretty, obvious answer. If you're not seeing results, then it's not working. But it's not always the case, right? So when you're going to prove if something is working, you have to make sure that, one, it's not just dumb luck. You're not just riding a wave. It's like the idea that in a bull market, everybody who buys stocks seems like a genius, right? Well, you didn't do anything. You just happened to catch a wave and you don't know what you did. And you seem smart. So does it mean that what you're doing works, or is it just a side effect? Also, if you have a system that does well and it's going through a down period, and maybe it's just because these down periods just are part of the system and it's just kind of recalibrating or getting back into the swing of things. So if you say that the system's not working because you're looking at a limited view, then you're going to throw away that system or abandon that approach prematurely. And so I just encourage everybody to really think about that. When you're deciding what is working, what is not working, how are you determining that? Are you making sure that you are accounting for any, biases? Are you making sure that you're getting the full picture? Because you don't want to abandon something that does work, and you also don't want to rely on something that you think works, but actually doesn't. So on that note, I will leave you guys. Enjoy your week. And again, hopefully you guys can take advantage of some of these insights, because I love when we have these high probabilities, right? I know I'm definitely looking forward to it. I already got my positions already set. Hope you guys do the same. Take care, guys.